The Australian Financial Review.
Hello, I'm James Thompson, Senior Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, as always, is my Chanticleer colleague. His razor-sharp insights are still tariff-free for all listeners. It's Anthony McDonald. How are you, Anthony?
Yeah, borderline strategy from Trump, isn't it, James?
Absolutely. Well, this week we go on the front line in Donald Trump's tariff war. We ask why Australia's second biggest private hospital operator is in intensive care. And we examine the first draft of Virgin Australia's plan to fly back onto the ASX. But first, Anthony, let's start with ANZ, the smallest of our big four banks, which was put back in the naughty corner by the prudential regulator for its latest risk management failure this week. Anthony, you said the ANZ has lost the trust of its regulator. How on earth did that happen?
How long have we got, James? ANZ, it's got one of the best markets businesses in town, James. The big institutional clients, bonds, currencies, trading, deals, syndication, all that sort of stuff. But there's been some bad behaviour in its markets business and allegations that even manipulated the market around a Commonwealth government bond deal, which it denies and says it can't find within its own trading systems. But ASIC is still investigating that one.
Yeah.
But meanwhile, because of these behavioural problems, James, which it does not deny, it called in the consultants to run an external review of its global markets business. Now, the report for that came back this week. ANZ released it. And to be honest, James, there wasn't heaps in this report, like 60 pages. But as far as these reports go, we've seen considerably worse. I mean, the worst of it was that poor behaviour, which was called isolated poor behaviour in its markets business, wasn't stopped in a timely fashion when it was reported by staff. So it goes up to management. Management didn't do anything about it. And that saw staff lose trust in the leadership. But the killer, though, James, and the thing that takes away all the ifs, buts, maybes, howevers, all that stuff for this story is that ANZ also signed an enforceable undertaking with APRA committing to clean up its non-financial risk practices and copped an additional $250 million capital charge. Now, that's something that no board wants to do, no management team wants to do. An enforceable undertaking for a big four bank, like that's serious naughty corner stuff, right?
Totally.
You don't do them lightly. While the language is that ANZ offered up an enforceable undertaking, the reality is you don't offer up these things willy-nilly. You only negotiate them if you really have to. So, James, we've got a situation where ANZ is signing an enforceable undertaking, even though it sort of claims it's done nothing wrong here. And APRA says the non-financial risk failures haven't really crystallised into a big loss, yet ANZ's still signing an enforceable undertaking, putting itself seriously in the naughty corner. So why would you do that, James? And in my head, the only reason you do that is because you've lost so much trust with the regulator, you've lost trust with your staff, which is actually in the report, and you're worried about losing trust with your customers, that you just do what you got to do to show that you're cleaning up your act. And ANZ had the ample opportunity, like all the banks have since the Hayne Royal Commission in 2019, to clean up this stuff. It hasn't done it. It might argue that the goalposts have shifted and that the regulators' expectations are higher than when they were.
Yep.
But they've got to be able to read the room as well. The standards on all this stuff have gone through the roof. So losing the trust, that was just the thing that made sense to me. It also, it sees Shane Elliott out, 9.5 years in charge of ANZ Bank. It's got to be a black mark on his tenure now, James, don't you think?
Oh, it's not the way you want to go out, that's for sure. And I'm with you. I think this is sort of like an accumulation of missteps that the regulators lost patience with ANZ and ANZ's just gone, yeah, you're right. We just keep stuffing up and we got to cop a little whack here. I guess, as you say, Shane Elliott's heading out the door. What's interesting to me is the new bloke, Nuno Matos. Yeah. He comes in. What a list of jobs. He's got to integrate Suncorp Bank with ANZ. He's got to get ANZ Plus, the sort of much hyped tech platform for the retail bank, up and running in a bigger and better way. He's got to get that markets business growing. He's got to win back a bit of share in the mortgage market, which is intensely competitive. He's got to stake out a little bit of ground in the business banking market if he can. And now he's got to see through this enforceable undertaking and win back APRA's trust. That is a huge list of things to do for a bloke who's been to Australia a handful of times and is not exactly deeply experienced in the local market or with the local regulators. That's a big job for any new CEO, let alone a CEO coming from sort of outside the country. So good luck to him, I guess. We'll see how he comes in. We get ANZ's results in May, and then it's Nuno Matos time, and we'll see what he can do. Anthony, you also broke some news around Virgin Australia, which is plotting a return to the ASX as soon as June, and has been out there talking to fund managers this week in what's called a non-deal roadshow. Now, you got the presentation, Anthony. What's Virgin's pitch this time around?
Well, James, I'm not sure there's any stories left to break on Virgin's IPO. This story's now 3 years old, and it's just a matter of timing. I caught up with a bunch of the investors who Virgin met this week, got the download. Virgin's telling them, it's a simpler, more disciplined, more focused, more sustainable business than the Virgin Australia that used to be listed on the ASX, James, and went broke during the pandemic with more than $5 billion of debts. Now, if you had to sum up its pitch, this time it's different. It showed investors a bunch of charts showing how its margins, balance sheet, and other metrics from the pre-administration days had improved, like seriously improved under Bain Capital's stewardship. Now, Bain was the one that bought it out of administration. You'll remember, James. And they were able to use that administration to renegotiate, they said, 500 plus contracts, and basically just sort of like reset the whole cost base, rethink the strategy. So Virgin's now finds itself in this sort of what it would argue is a happy middle ground, somewhere between Qantas, which is a bit more premium, and Jetstar, which is more cheap and cheerful. It's got about a third of the domestic flights market, and it's making pretty good money. I mean, its earnings margin is about 11%. Qantas and Jetstar's are more like 16 to 18%, but it's not a really clean comparison. But basically, Virgin's doing all right now. But you got to ask though, and investors did as they came out, is this sustainable? Like, do the Virgin crew have that avgas in their veins that gets into airline management teams' heads, that makes them go offshore, makes them want to get premium, makes them want to do first class flights, all that stuff that could potentially derail this happy middle ground, profitable airline story.
Yeah.
So
the middle ground's a hard place to be often, Anthony. We see this in a lot of sectors. You either want to be at the bottom or the top. Being in the middle, you sort of a bit of everything, and occasionally you end up being nothing. I mean, I think they've staked out a reasonable patch. Good on them. They've turned the business around out of administration. But whenever you hear the words in financial markets, this time it's different. You go, oh, okay.
Yep.
Is it different? I mean, I look at the market. It seems to me that Qantas is still there. Jetstar's going better than ever. I just can't quite see how, should Virgin start to grow, Qantas doesn't just go, hang on, a little bit more competitive pressure here, tighten the screws a little bit. Doesn't that just happen again? I mean, that's how sort of very tightly controlled markets work.
I agree with you, James, but Qantas, look at its share price, absolutely flying. Why is it flying? Because it's creaming its customers. Does it want to give some of that money back by taking on Virgin in a price war? All right. I agree with you. At some stage it has to happen. All right. But it hasn't happened the past couple of years. At the end of the day, this deal's going to come down to price, James. Like, I think Virgin can show that there's a market there for what it's doing now. It can maybe get investors to believe that management's not going to do anything too silly for the next couple of years. But it's all about price. There's no way they're going to be able to float it at the same sort of price that Qantas is on. If they take it a big enough haircut to that, then I reckon they'll find a market for it and it'll get done on one big condition, James.
Oh, yes.
We don't have any more nights like Thursday night. Airlines got absolutely smoked. In the US, like, shares are off 10%. If airline shares have a few more days of 10% south, then we are wasting our time even talking about this float. It will never, it cannot happen.
We've talked about the incredible shrinking ASX a lot on this podcast. It'd be great to have another airline stock on there.
Yeah.
And investors who keep whinging to us about, why isn't there any fresh companies to buy, they will want to back this company. But I'm with you. If they manage to get this float away in June, under the threat of tariff wars, with US airline stocks in the toilet, with investors skittish, then there needs to be a statue built in Martin Place or in Collins Street, with the team of bankers behind this business and perhaps Bain Capital's CEO as well. It'd be a fair effort. Wish them all the best, but they're flying into a bit of turbulence on markets, which we're going to get to next, I think.
That's right, James. You're obviously hot to go on the tariffs. Let's get straight into it. And this week has been all about the tariffs. At 7 a.m. on Thursday morning in Melbourne and Sydney, Donald Trump got up in the Rose Garden at the White House and declared that Liberation Day for America was finally here. The world's biggest economy would stop other countries, and I quote here, raping and pillaging its economy by hitting them with reciprocal tariffs. James, the baseline tariff was set at 10%, but using a big prop sign, Trump announced a range of individual tariffs on individual countries, 34% for China, 20% on the EU, 24% for Japan, 32% on Taiwan, 25% on South Korea, 26% on India, and 46% on Vietnam. James, we got away pretty lightly here in Australia at 10%, but bizarrely, Norfolk Island was slapped with a 29% tariff. Now, James, markets had been bracing about this for weeks. We've been talking about tariffs non-stop on this show. But was it better or worse than feared?
Oh, man, it was so much worse.
Yeah.
If you look at a graph of the S&P 500 futures as Trump spoke for an hour, I mean, shock horror, the guy can talk. First he announces, there's going to be a 10% baseline tariff, and the market ticks up because they'd expected a 20% baseline tariff. They're thinking, fantastic. You know, we've weathered the storm here. And then he brings out this giant sign. You know, he loves a prop, Trump. And he starts reading all the tariffs, you know, we're hitting China with 34%. We're hitting Japan with 24%. European Union, 20%. It just went on and on. This was the worst of both worlds. Yeah. It would have been easy to understand a sort of baseline tariff, the same on everybody. That would have been easy to understand. Or specific country tariffs, that would have been relatively easy to get your head around too. Instead, we got the worst of both worlds, a bit from column A and a bit from column B. What a disaster. I mean, the ASX 200 actually held up really well on Thursday. Hats off to the brave Aussie investors who stuck their war helmets on, bunkered down in the trenches and tried to keep their head down. But Wall Street on Thursday night got smoked, absolutely smoked. I haven't seen anything like this since the sort of the dark days of the pandemic. 4.8% the S&P 500 was off. Oil was off, 6.5%. Bitcoin got smashed. Copper got smashed. The Magnificent Seven got smashed. And what's really worrying here is the US dollar got smoked. Now, everybody thought that the US dollar would rise when the tariffs came on because the tariffs would hit all other countries harder than they would hit America. But suddenly the US dollar is falling because people are losing confidence in American exceptionalism. Not just American exceptionalism, I think American sanity. This Trump tariff plan is such an example of economic self-harm that it's just hard to believe it's actually gone ahead. And I think that's what you're seeing markets react to. You speak to so many investors and they've always said, he won't do it. He'll talk about it. Yeah. He might threaten it, but he won't actually do it. And now they're having to wake up to the fact, hey, he's going to do it. It's here. It's happening. And markets assets are having to be repriced across the board. It's pretty historic what's happening. I was a very young pup during the GFC. This has got that sort of wake up every morning, what the hell's happening feel to it. It's pretty amazing.
Yeah, I agree, James. The announcement itself was pretty bizarre. That sign, it was like the old tuck shop sign, wasn't it? Which would normally say meat pie, $2, donut, $1. Chocolate milk, $2.50. It was just like that. It was just such a prop. It was all built for theatre. And that was after that he pulled out this book that was bigger than a Bible that was apparently it was like the culmination of the study of all the trade relationships that had been done. Like it is just an absolute show they're running over there. And it was almost like 100 years of free trade just got wound back.
Totally.
In a series of announcements.
You're exactly right. We haven't seen, the average tariff across the American economy was 2% at the start of the year. It's now 29%. We haven't seen tariffs this high since the 1930s.
Wow.
I don't know if you know how the 1930s ended, Anthony. It wasn't great.
The Bradman era. Far lap.
That's right. That's right. It's hard to get your head around. It really is. But, here we are, and this is the problem. The markets keep trading. Investors got to keep doing things, and we got to deal with it.
Yeah, but it's all about making Americans wealthy again, isn't it, James? Yeah. And it also had that extra Trump bit that seems to follow him everywhere. We're in the background. It's a bit like, hang on, is this real? Is this just a negotiating tactic, or should BHP seriously be preparing for all this stuff.
That's the most important point. Had Trump come out and said, these are the tariffs, we're sticking with them for the next 4 years, like it or lump it, and walked off, everyone would have gone, okay, well, yeah, okay, we better get used to it. Instead, what we've got is Trump's, sidemen, Howard Lutnick and Scott Bessent, the Trade and Treasury Secretaries. They're walking around saying, look, if we're up for negotiations, anything could happen. And so you just get uncertainty on top of uncertainty. Are the tariffs real, or are they going to be wound back before April 9 when they kick in? I don't know. Are countries going to retaliate, or are they going to beg for exemptions? I don't know. Picture it's easy for us. We're sitting on the sidelines in the peanut gallery.
Yeah.
But imagine if you're a CEO out there trying to make decisions through this. The only decision you make is to say, we're not doing this. Stop. We are not doing this, and we'll wait until there's a bit more clarity. Now, the problem is everybody starts doing that around the world. You can see it in deal markets, which have, really come off, particularly in the US. You can see it in the commentary from US CEOs. And the problem is that if everybody starts doing this, and everybody is doing it, the economy starts to grind to a halt. People say, okay, well, we're not going to invest in this thing, and we better cut some costs. We're not hiring those people. We're going to lay off those people. You almost talk your way into recession. And so you've got this uncertainty on top of uncertainty, and then you've got Trump saying, oh, I don't care. This is the medicine that the US economy needs to take. Just bear with us. It'll all turn out fine. And I don't think anyone believes him. But we're a long way from the Rose Garden in the US. What's the hit for Australia? Should we be panicking down here? I mean, the RBA kept rates on hold on Tuesday, but all of a sudden, economists are talking about maybe 4 or even 5 rate cuts for calendar 2025. So, we've already had 1. There could be another 4. Could things seriously get that bad that our economy needs 4 more rate cuts?
In terms of the headline, I mean, the economic effects from the tariffs themselves, James, we got off pretty lightly. And we don't trade that much in terms of actual goods with the US in either direction, really. Sectorially, slight negative for agriculture, steel and aluminium, pharma. I mean, Trump went so far as to call out Australia's beef exports to the US, didn't he? I think he said Australians sell $3 billion worth of beef into the US and accept none of the beef back. Which I think is for safety and biosecurity reasons. But that 10% reciprocal tariff, I mean, that shouldn't directly hit our trade too much. But these things, James, as we've said before, they're always about the knock-on consequences, aren't they? Yeah. And there's some big, big tariffs on our Asian neighbours who are our biggest trading partners. China, Japan, Korea. They're the big buyers of our natural resources, James, of our biggest exports. And I mean, the other one is the sort of indirect risk of the whole economic cycle. Like, what happens when global economic growth from these tariffs slows down?
Yep.
Like you said, most economists are tipping a slowdown in the US, perhaps even a technical recession over there by the middle of this year. What does that mean for growth, inflation, rates? There's this sort of like well-known notion in financial markets that as soon as global economic growth falls, Australia's economy is one of the first to fall with it, right? I think the IMF had some old numbers that said if there's a 1% shock to the US GDP, typically hits Australia's GDP by 0.4%, right?
Mm-hmm,
so it's like a material impact. So it's just it's the interconnectedness of things, James. Like, look at the way the interest rates go up and down between us and the US. We've seen it in the past few years. Like, it's, we seem to sort of lag them in 6 months, and it's not a coincidence. It's about the way the goods flow. It's the way that money flows around everything. And you said up top about 4 or 5 rate cuts. I mean, 5 cuts from here, that would get us down to 2.85% by the end of the year. 4 cuts would get us to 3.1%. It's possible, but you'd think with the way that the government's spending its way through everything at the moment, and given the tight jobs market, I'm not sure I think it's probable, but like, no one at the start here was talking about 2.85, were they? It would be quite amazing.
Anthony, no one at the start of the week was talking about 2.85%. This is how quickly things are changing. I mean, as we said, US shares were smoked on Thursday night. They're now down about 12.7% from their peak. ASX 200s, held up okay Thursday, taken a battering on Friday. We're getting perilously close to a correction here, Anthony, which is a fall of 10% from the peak. What are the big concerns amongst investors in Australia?
Well, everyone was sitting around looking for the noise through the signal, weren't they, James? Isn't that one of the cliches of 2025?
The signal through the noise.
Sorry, the signal through the noise. Like, seriously, like it's just over and over and over. Anyway, it seems like Thursday night I don't know if people found the noise or the signal or what, but they obviously found the sell button, and it's sent markets sort of crashing on Thursday night. You say Friday morning our time, biggest sell-off since COVID, and no one picked this. And here in Australia, James, we're so far from immune. Like I said, that interconnectedness. And if you just look at our market, if you look at the ASX, if you think about the fundamentals, earnings growth here, James, it's very benign. The RBA expects the economy to grow 2.4% this year, 2.3% next year. I mean, they're forecast from February, so you could probably tear them up, really, given what's happened. But point is, we weren't on a path for massive growth. Anyway, interest rates are still mildly restrictive. The consumer's sort of stretched but not fallen over. The ASX is trading at 17.3 times forward earnings per share. The historical average is sort of like 14.5 to 15 times. So we're still expensive, James. Valuations are still stretched. On a dividend yield basis, the 12-month forward dividend yield is 3.7%. Now the 25-year average is 4.5%, right? So we're still expensive on that metric too.
And you can get above 5% with a term deposit at the bank.
Totally. So if you're of the mind that there's a sell-off coming, then there's still reasons on evaluation grounds for it to go further. Now, I'm picking up from what you're saying, James. You still seem to be pretty bearish, right?
Look, I am. I'm going to give you one ray of hope, though, Anthony.
Yep.
It's our friends in China.
Uh-huh.
Think about it if you're the Chinese president at the moment. Trump's whacked a 34% tariff on you. But it's not just 34% because you've already got a 20% tariff on you. So you're dealing with tariffs of 54%.
Yeah.
US is one of your biggest export markets. I mean, how do you react to that? China's been sort of limping along. Their economy's been battling along. They've been talking about doing some stimulus. Surely it's time you get the big bazooka and just fire money around the place. This is what we've got to watch for next. What are the reactions to this? Now, China could, engage in a trade war. That'd be terrible. But if they go down the stimulus route and try and pump up their economy, that could be great for Australia because they're going to need a hell of a lot more iron ore and lobster and wine and all that good stuff that we send them. So that's the ray of hope. The other thing is what we tend to see after sell downs of, 10, 15, 20% is we tend to see a bounce back. The record after these sell downs is pretty good. Yes, this is not comfortable for anybody, but we've had a few good years, really good years, and we're seeing what you might call a healthy pullback. That's me trying to impersonate a bull, Anthony. But look, I think hang on to your hats. On Friday night in America, they get jobs data. Now, the jobs numbers have been ticking along okay. If there's a soft jobs number, then the recession fears are going to go through the roof after this dramatic week, and we could see a really big leg down. So let's hope that's not the case. Yeah. It's getting nasty. Anything else you're watching for quickly?
I hope you're right, Reed China, because if they don't, who else is going to buy the 900 million tonnes a year of iron ore that comes out of the Pilbara? Because we in Australia, we don't need it. Who's going to buy the 2/3 of our gas production that we send offshore to Japan, Korea, and the like? We don't need it. Who's going to buy the 200 million tonnes of coking coal that comes out of the Bowen Basin every year? Like we don't need it. Like we need this trade to keep flowing, James. Like trade's a good thing. So hopefully we all end up realising that.
Otherwise, it's going to be a very big garage sale. All right, Anthony, for our second topic, I thought we should sink our teeth into what I reckon is emerging as one of the deal stories of the year. Private hospitals operator Healthscope is back on the sale block 6 years after it was taken private by Canadian giant Brookfield in what's called a leverage buyout, which just means that they use a big chunk of debt to get the deal done. Now, that's all looking a bit worse for wear. Brookfield has called in the bankers, the opportunists are swirling around this situation, and it looks like something's going to happen at Healthscope in the next couple of months. Anthony, this is an important deal because Healthscope is the second biggest private hospital owner in Australia. It owns 38 private hospitals, including the Northern Beaches and Prince of Wales private hospitals in Sydney, Knox and Melbourne private hospital down here in Melbourne. And so what happens to this business does have a material effect on Australia's health system. It's been bought and sold a few times in recent years, most recently by Brookfield, as we said. But this isn't your usual happy private equity exit. What's going on here, Anthony?
James, I think you're right. Like, we talk a lot about deal stories on the podcast and we write a lot about them. But the truth is, it often doesn't matter who owns a business. You know, ownership transfers all the time. For most of us as customers, you don't even notice. Like, tell me, you go to Sydney Airport all the time now. Like, do you even notice that it was taken out in a $32 billion buyout in 2022? No. It's all the same, right?
Not really.
This one's different, James. Like, it does matter. It's 38 private hospitals, the second biggest player in the sector. You know, there's two big wigs in the sector, Ramsay and Healthscope, and it's daylight to the rest. These private hospital guys, they do 60% of the elective surgery in Australia, James. So it's hugely important to the overall healthcare system. Chuck all those patients back into the public system and, you know, the whole thing would burst at the seams. Now, Healthscope has too much debt. That's the problem here. The capital structure they've got, it's not sustainable given the pressures on its revenue and earnings. And to understand why, James, you sort of have to go back to the time that Brookfield bought it in 2019. So Brookfield paid $4.4 billion on an equity value basis, 5.7 in terms of enterprise value, which includes debt. Now, it was a big price. It was competitive. And the reason that Brookfield could pay such a big price was at the same time, Healthscope agreed to offload 22 of its hospitals to two real estate investors for $2.5 billion.
Okay.
So those properties were sold with 20-year leases back to Healthscope. The buildings are hospitals, right? They're not really good for anything else.
Yeah.
So the property gets sold on the back of these strong leases to a hospital operator. Brookfield can then afford to come in and buy the operating business and what was left of the property portfolio. The whole deal gets done. That was mid-2019. Now, what you've got since, James, though, is Brookfield running Healthscope and with an extra expense, right? It's got rent expense now for the first time,
of course,
which it didn't have to pay. It's got 22 hospitals, has to pay rent on all the time. It becomes a big expense for it. So like I said, completes in mid-2019. And what's happened since then, James?
Well, we've had a pandemic.
Exactly.
We've had a burst of inflation. We've had high interest rates and everyone's wages have gone up.
Exactly. All that stuff, James. So start with the pandemic. Elective surgery stops. That's the main money spinners for a private hospital. Then it starts up again, but volumes are sluggish to get going. And then the great reopen happens. Inflation comes. That's more for medical equipment, then wages, nurses, pay rises in the public system. Private hospital operators have to match it. Then you get this influx of nurses for the aged care system under government regulation. Once again, private hospital operators have to sort of match those paying conditions. Volumes pick up in the hospitals, but nowhere near as fast as they needed to. Costs are up, and they've got no control at all over the third lever that businesses have, James, price. These guys are price takers, right? Now, in terms of revenue in the system, it's funded by government and private health insurance. Private health insurers used to pay 88 cents in the dollar to the hospitals. Now they're paying 85 cents. Doesn't sound like a much, but that's $1 billion that's disappeared. So you've got an industry that's on its knees. Smaller private hospital operators are losing money. The number one group, Ramsay, is making money, but it doesn't have to pay rent, James, because it owns its property because it's never had a private equity buyer come in and sell them off. And then you got Healthscope, which is losing money and pays rent. And what makes it toxic, James, is that it has debt. And we see this all the time. As soon as you have debt, you're weakened, and it has debt, and it has rent to pay. It's got $1.6 billion in debt. It's not sustainable, not able to be refinanced. So it's at the mercy of its lenders to some extent. Some of them are getting nervous and selling out. Others are getting nervous and just staying in, but they're pushing Brookfield to sell it. And if it does get sold, James, that first $1.6 billion, assuming it gets there, goes to the lenders, and Brookfield's probably toasted most of its equity. So that's the sort of story in a nutshell. I obviously think it's incredibly important, but James, at the heart of all this are the woes in the private health system, right? It's that battle between hospital operators and health insurers. Like I said, the health insurers are retaining more of the revenue pool than they did in the past. Can you tell us what's that relationship like between private hospital operators like Ramsay and Healthscope and the private health insurers and the government, which is sort of over the top of both?
Anthony, do you know the band Oasis?
Yeah.
Great Britpop band of the 1990s, fronted by two brothers, Noel and Liam Gallagher.
Yeah.
Well, the private health insurers and the private health hospital operators are a bit like Liam and Noel. They absolutely hate each other, but they need each other.
Yeah.
It doesn't work unless they're both doing well.
Yeah.
And this is a problem we've got to. 10 years ago, the private health insurers were basically accusing the private hospital operators of coining it at their expense. Mm-hmm. And now we've got the opposite thing. The private health insurers are doing very nicely in terms of their profits, and the private hospital operators are on their knees. So it's all about trying to get this tension between them, which is sort of healthy in a way because it's aimed at getting the best results for patients, finding a way of getting that tension right. And I think at the moment, the balance is tilted towards the insurers and away from the hospital operators. The hospital operators are saying to the insurers, look, if you want us to be around, which, by the way, is what your customers need, then you need to give us a bit more coin. We need a bigger slice of the profit pool. And of course, the insurers are saying, hang on, don't blame us because you've run your hospitals poorly and because you've missed some of the trends they claim in the way healthcare is provided. So we've got these two sort of siblings, up against each other. They're like the Gallagher brothers. They say very nasty things about each other in public. But I think exactly like Oasis, the brothers are gonna have to come back together to get us out of this mess. So if we were to see Healthscope close a lot of hospitals, it would be a wake-up call for the industry, and they'll be forced to find some resolution. At the moment, I think everybody both sides wants the government to step in and somehow solve this problem. But that's the thing, Anthony. We're at such a sort of crisis point that the opportunists are sniffing around here now. Who's lining up to buy Healthscope? How does this play out from here?
Well, there's only one that's put their hand up publicly, James, and that's David DePillo's HMC Capital, which has never operated a hospital in its life, but it's knocking together a syndicate of investors for a bid. Now, David DePillo, I don't know if he needs introduction or not on this podcast, James, but he's the deal maker behind the Sigma Chemist Warehouse deal, the $2 billion Digico float. He's done a lot in the past few years, and he's rustled together a lot of deals that people said could never happen. He's never to be discounted, but I mean, he doesn't come at this from nowhere, James. So HMC runs a property trust called Healthco Wellness, which is listed on the ASX. Now, it's one of those two big real estate investors that owns Healthscope's properties. Healthscope breached its contract for rent in March, and HCW, this REIT, it then kicked back and said, all right, we're going to enforce our legal rights, and we're going to look to replace Healthscope's tenancy with other hospital operators in the events that the rent's not paid. Now, that brings HMC and its potential syndicate into play. They've put their hand up. They've said they're interested. Now, outside of that, James, there's not many other players of scale in the sector. And like I said, most of the smaller ones are battling with their own financial troubles because it's tough times. And there's not many big global sort of hospital groups that are looking to expand in the Asia Pacific or Australia. We've sort of seen over the past 2 decades that this big global hospital network doesn't really work because they are so reliant on the regulatory environment, which is localized.
Local, yeah.
Yeah. So, I mean, the big contender, James, the one that no one's talking about is Ramsay Healthcare. All right. Yep. So it's the big, well-capitalized, has access to funding, strategic in the sector. Like, it is the adult in the industry. All right. Now, it won't come out and say anything, and you wouldn't expect it to. But if Brookfield hasn't been trying to deal with Ramsay, at least sell at some of the hospitals, some of the ones where there aren't competition problems or overlaps, then Brookfield's not doing its job properly. Like, I'm not a banker, but to me, that just seems so obvious that they're going to be part of the mix here. And, if they don't step up, James, and if people like HMC, the opportunists, the private equity people can't get funding, get this deal done, what do you think will shape as the backup plan, James?
I don't know, Anthony. And this is the thing that I think is really makes this deal special. Okay, this is a privately owned business, right?
Yep.
But it's not just that. It's also vital community health infrastructure. And that colours everyone's actions in here. I mean, Brookfield doesn't want to be responsible for doing a deal where hospitals shut. None of the lenders, who include the big four banks, they're not going to want to approve a deal where hospitals shut because there's people booked into these hospitals in, I don't know, June, July, August, September for operations. Yeah. You want to tell them, private equity deal gone wrong. You know how it is. I mean, we can't do that. So you might end up, if it all comes to it, maybe the government does have to step in and backstop losses or something like that. I don't think the government has shown no appetite for something like that, but I guess the government didn't want to backstop losses at the Whyalla Steelworks or at Rex Airlines or, the taxpayer could end up owning hospitals as well as steelworks and airlines, Can we own a bank too? I think we do. We used to.
Yeah, I think James, chuck it in. You're helping out a mate fund for you and your 25 million fellow Australians. Like you said, alongside Whyalla, alongside Regional Express, looks like it's going to head that way.
Yeah, it's an absolute mess, but I think it's a really important deal situation that we'll be watching. I mean, so many people would know somebody in their family or friendship group who's probably going to one of these hospitals sometime in the not too distant future, or another private hospital or public hospital that will have to deal with the overflow of this. So we'll be watching it very closely. All right, Anthony, there's some big meaty topics there, but we're going to come back with another company that's in deep trouble and have a look at that. Back in a sec. If you want to know more about what we're talking about today and a whole lot more, AFR subscribers can sign up to the Chanticleer newsletter at join.afr.com/Chanticleer. Every Saturday morning, the newsletter pulls together the best Chanticleer columns from the week and delivers them straight to your inbox. All right, Anthony, another big week. We've been talking about hospitals and healthcare. It just so happens that the Australian Financial Review's Healthcare Summit is on Monday. Oh, what perfect timing.
Unfortunately, Healthscope's not there, James, but Ramsay is. Medibank, right, the biggest health insurer. So I reckon this funding debate will be right at the heart of the day.
Yeah, brilliant. I mentioned where there's another company that's really in a lot of trouble that we've been watching on the podcast for some time. That's the Star Entertainment Group, the casino operator. Anthony, their big rescue deal unfortunately fell over last week. Is there much cash left to keep this thing going for much longer?
No, James. There's days worth of cash left. This thing's really struggling. The latest blow, James, they were supposed to be selling that stake they've got in the Queen's Wharf Casino and Resort up in Brisbane. They were supposed to be selling it to a joint venture partners. Now, that deal was supposed to be signed properly on Thursday. It's now Friday. The deal's still not signed. It seems like Star's even stopped pushing for it to be signed. Why is that? Is it because it's about to pull a different refinancing out of its hat? Yeah. Or is it because it's about to go into administration, James? That's the question for this weekend.
Yeah, okay, we shall see. And Anthony, I'm not sure if you remember amongst the excitement of Liberation Day, there's an election still going on. I think probably the biggest moment of the week was poor old Anthony Albanese falling off a stage. Yeah. Hopefully he's okay. Do you think this turmoil on markets helps the incumbent or the opposition?
Normally it helps the incumbent. In times of danger, you stick with the same. What about you?
Yeah, I think you're probably right. I mean, I think the election's really struggling for attention at the moment.
Yeah.
That might change, but it might not too, because the next few weeks we're going to school holidays, we're going to Easter, we roll into Anzac Day. I reckon the parties are going to have a real job trying to cut through. Anyway, let's see how it goes. Maybe a few more stunt falls off stages might be the way to grab the electorate's attention. All right, well, we love questions here on the Chanticleer podcast. This week, our question's from Mark. If you've got a question you want to send in, you can email us at chanticleer@afr.com. You can also send us a question in audio form. Just record a voice memo on your phone, include your name and where you're from, and email it to us. So Mark asks, "Hi guys, love the podcast. For my 10 cents on housing, I'd like to make the following points. It's taken 40 years of self-interested policy decisions to get us into this mess, so it's highly likely there's no silver bullet. Instead, it will require years of consistent policy from all governments. Making primary residences subject to capital gains tax would be a step in the right direction. Currently, policy settings encourage overinvestment in limited housing stock, and this has two outcomes. It forces prices up, and it robs investment from more other productive sectors of the economy. Would it be possible to have a phased-in program to introduce capital gains tax to primary residences over a period of years, starting at a very low level and then gradually ratcheting up over time? It would be difficult as a society, but we need to balance competing interests." This is a really interesting idea, Mark. I like some left field thinking, but we just spoke about the election, Anthony.
Yeah.
Which party do you think would like to tell people they've got a tax on their house?
The Greens, a stretch.
Yeah, fair answer.
No, I almost fell off my chair when you read this question, James. That would be a big, big shock. I mean, lots of people, the primary source of their wealth is their home. And, I mean, they're sitting in their home. This would crystallise a huge tax burden for them if they sold their home. I would worry about what it does for that social contract we've been talking about recently, James, about older people selling their homes to younger people that need more space. As soon as you put more tax and more friction in that sort of what should be a recycling of property, it becomes harder. So then do you only just bring it in for sales that happen from now to the future, right? You sort of grandfather these laws. And then, so you could do that, but then who's picking up the capital gains tax burden, James? It's the people that are buying the houses. It's the young people, right? They won't have the chance to get wealthy in the same way as their parents and their grandparents did before them without paying tax on that wealth. So are we unfairly hitting them? I don't know.
Yeah, I think you've raised a really good issue. Like, how would you grandfather it? I guess what Mark is saying is that you'd start it at a very low level and hit the people who are already in their houses. I guess it's, a form of wealth tax in a way.
Yeah.
And look, I don't think Mark's idea has got any chance of being introduced. But what I would say is he's probably thinking in the sort of right direction, because how do you close these inequality gaps? And as young people get more and more grumpy about the social contract breaking down, I think things like taxes on wealth, and as you said, most wealth is in housing, are going to become more popular. So perhaps it would be better, Mark, if we did bite the bullet, take our medicine and start this. But I just think it's a very, very difficult task to get the sort of bipartisan support you would need to introduce this policy and stick with it over a long period. I mean, as soon as one party said, okay, we're going to do this, you can guarantee at the next election, the opposition's major promise will be, we'll be knocking this tax over. So yeah, that's sadly a bit of the short-term thinking we've got. All right, Anthony, what a big week. We've survived Liberation Day but I'm not sure what lies around the corner for us, and we can't wait to have a look at it. It's feels like history being made every morning. So stick with the AFR. We're all over it.
Yeah, I hope you get some actual liberation on the weekend, James.
Thank you very much, Anthony. We'll see you all next week. If you like the podcast and you want to hear more, consider sharing or giving the podcast a review, as it helps other listeners find us. And don't forget to follow wherever you get your podcasts. At The Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com and you can subscribe to The Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, James Thompson and Anthony McDonald, and it was produced by Alex Gow and Lap Fan. Our theme is by Alex Gow, head of podcast is Lap Fan, and the head of premium content is Fiona Buffini.
The Australian Financial Review.